I'm Claire Trott, Head of Pension Strategy at Technical Connection. Today we're going to talk about pension death benefits. What we're going to go through today are the options on death. We're then going to look at the taxation, so the lifetime allowance and the income tax implications of the death benefits and when they happen. We're always asked about the special lump sum death benefit charge and how that applies when benefits are finally paid out from the trust. So we've got an example to go through of that at the end. So under defined benefit schemes, nothing changed when we had the pensions freedoms. Usually, widows' pensions and dependents' pensions are payable, but do take care when you're talking about these beneficiaries' options to check what is deemed a widow on death. This could be spouse at date of leaving, spouse at date of retirement, or spouse at date of death. And it can make a massive difference, especially in today's day and age, where things change and people move from being married to being divorced to getting remarried. It could mean that the death benefits are going to end up in the hands of the wrong person. We've also got the lump sum death in service benefit. This is something, if it's paid out under a pension, uses up the lifetime allowance, but it is always a lump sum, and that's the most important thing to consider when we're doing this. Benefits will always cease on second death. Or when dependents come of age, and that's usually age 23 or when they cease full-time education. So defined benefit death benefits are something that are much less flexible than what we're used to seeing now under the pension freedoms and the defined contribution schemes. So looking at defined contribution schemes, so much more choice is available. We've got lump sums and we've got income. But again, we need to be really careful when we're looking at these to ensure that the scheme allows them. Most schemes will allow a lump sum, but not all schemes will allow beneficiaries drawdown. As a rule of thumb, I tend to think that if you've got drawdown in life, you're going to have drawdown in death. But I would always urge you to check well in advance that whether or not the client will be able to opt for the benefits that they want. One of these things is to get the expression of wish. The expression of wish for the scheme will make it very clear what is and isn't available. It's also very important to ensure that that expression of wish is always up to date so that the right beneficiaries are contacted should the client die. If they don't have the contact details, it will be very difficult for them to do the right thing. So just looking at the income options under this, you could have, as I mentioned a minute ago, beneficiaries flexi access drawdown, but you could have a beneficiaries or a widow's annuity. That's also an option. So there are many options available, but again, do remember to double check what the actual scheme you're looking at makes available. Do remember that if your client comes across a pension scheme that they had many years ago, or the widow of a client comes to you and says they found a pension scheme that their deceased partner had, that it will depend on when they died as to what options are available. So should a pension scheme come out the woodwork where the client died before 2015 in the pension freedoms, those death benefits available at that time will be the ones that are applicable. So there may be restrictions on what they can and can't do. So it's very important to understand the taxation of death benefits. And I've split these again into DB and DC, and I've split them down further into lifetime allowance and income tax, because we have to deal with each one separately, although they do interact to a certain degree. DB schemes and the lifetime allowance, again, these aren't part of the pension freedoms. So there was very little change in 2015 when we saw lots of wider bearing in taxation. But they are mainly tested against the lifetime allowance. So death in service lump sum, if it's part of the pension scheme, will fall against the lifetime allowance under BCE 7 if paid out within 2 years. However, the one thing that isn't caught under the lifetime allowance is spouses or dependents pension. At no point is this tested against the lifetime allowance. So should somebody be getting a very large death in service sum, they won't necessarily then have the add-on of the spouses or dependents pension to use up more of the lifetime allowance. It's good to remember that the lifetime allowance in death is always payable by the beneficiary receiving the funds. It's a responsibility of the personal representative to collate the information, report it to HMRC. HMRC will check things with the scheme and will eventually send a bill to the beneficiary. So if you're talking to beneficiaries, they need to be made aware of this if there's going to be a lifetime allowance charge, because it's not the surprise that you want to be receiving. For the DB schemes and the lifetime allowance, it's likely to be obviously the death in service lump sum that causes this tax charge. So this money should be in their hands in order to pay the tax charge, which is payable through their self-assessment eventually. Just looking at income tax on DB schemes. Spouses and dependents pensions are taxed as income. So they're taxed PAYE, and there's no exemption to income tax for death before 75. It's very important to remember that whatever happens, the income tax will be payable on a scheme pension for a beneficiary. The death in service lump sum is treated as a money purchase benefit. So again, income tax free if pre-75 death occurs and paid within 2 years of death. The likelihood that someone will be subject to income tax on a death in service lump sum post-75 is fairly unlikely because most people aren't working post-75, so death in service benefits cease. On to defined contribution schemes and the lifetime allowance. So uncrystallised benefits are tested on death. If they're settled within 2 years and pre-age 75, then there will be lifetime allowance tests. So BCE7 again for a lump sum, BCE 5C and 5D if designated to drawdown or to an annuity. If you don't get round to settling those death benefits within 2 years, or the client dies after the age 75, then there's no lifetime allowance test. So it's very important that should you want to make sure that everything's settled within 2 years, because it has a knock-on effect to the income tax, which we will see in a minute. Again, as I mentioned earlier, lifetime allowance charge is payable by the beneficiary and responsibility of the personal representative. It's important to remember here that there's no way to decide what order things happen on death. Everything technically is crystallised at the same time. And what happens with any lifetime allowance charge is it's proportionately split across all the schemes and by the amount of tax that they're paying, so be it 25% or 55%. On DC schemes, as I mentioned in the previous slide, we've got this 2-year rule. This 2-year rule means that if you designate benefits within 2 years under the age of 75, they're free from income tax. So we need to make sure that we're doing that promptly to get that dealt with. If it's not settled within 2 years, or if the death is post-75, then they become subject to income tax under PAYE. And if the lump sum is paid to a trust, there's the special lump sum death benefit charge, which is a flat rate of 45%, which means that you're only going to be investing 55% of the sum into that trust. There is a payment back to the beneficiary. So there's a credit to income tax when money is paid out of that trust. And we're often asked how that works. So I've just put together a small example to show you. So we've got £100,000 in fund on death, and it's left to a trust. So this is post 75. So there's a tax charge of 45% on that, 45,000, leaving only 55,000 to be invested within the trust. The trust now has grown to 85,000 before any income is taken, and we need to calculate the tax reclaim available to the beneficiary. On conversation with HMRC, it's become clear that there are really 2 options available to the trustees. Either the whole payment to the beneficiary is attributable to the original payment, or its proportionate part of the payment is to the beneficiary attributable to the original payment, and the other part is to capital growth. There's a difference to the amount of tax reclaim that they can use dependent on these 2. So let's look at our example again. So option 1, the beneficiary will be treated as having received a grossed up payment of £18,182, assuming that they're taking a £10,000 income payment. Of that, tax would be treated as £8,182 that's already been paid. So this will give the beneficiary a tax credit of £8,182. The other option is to be part growth, part capital growth and part tax. So one payment again, £10,000, and we're attributing that on the growth part. So 6,471 will be treated as the original payment, and 3,529 representing capital growth. This will give the beneficiary a tax credit of 5,294 on the overall payment. So they'll actually be getting slightly less, but it does mean that there will still be more tax credits to be available at a later date when further income is payable. Thank you for your time, and hopefully that was useful.